Okay, so good afternoon, everybody, or morning, or later into the evening, depending on where you're based. We have quite a widespread group on the call today. But thanks for joining this One Nucleus session that we're doing in association with Seven Life Sciences. I guess nobody can fail to have noticed how much noise and interest there is around SPACs at the moment in the markets, and life sciences is no different to other sectors in that sense. But I think as we're seeing more and more of this activity, then a chance to gather as a group and hear from some of those on the inside, if you like, or in various stakeholder perspectives, just what are the key factors to look out for, either as good signs or as red flags, because ultimately we'll have to start differentiating between what makes a good or a not so good SPAC, because not all SPACs are the same, is my guess, like most things in life. So I'm delighted we're able to do this session with you, and very pleased that Chris Farmakis, who will be moderating, approached us to do this, and with the support of Paul and the team from Seven. And thanks to the speakers, who I'm sure will articulate their backgrounds and share their insights as we go. The session is being recorded, just to alert everyone. From a housekeeping perspective, as you may have noticed on the way in when Alicia spoke, just to make sure if people could please stay on mute and off camera would be ideal whilst the speakers are going. We'll run through the presentations. And if you want to put questions or comments as we go in the chat box, then Chris will be keeping an eye on that and coming back to those questions as we get time at the end of the session. We have plenty of time. And I hope everybody enjoys it and learns a lot, has some good questions provoked. I look forward to watching it from here. So over to Chris.
Yes, hi, good afternoon or evening or morning, everyone, and thanks for joining. And thanks, Tony, for your kind words. Let me start by saying not all of us are very familiar in running a virtual event, even though we have done plenty of physical events. For some of us, it's the first time, so apologies for any mistakes done beforehand. I believe everybody has been hearing the SPAC term, increasingly so in the UK and Europe, and in many places beyond North America, where it's prominent. Everybody's entitled to an opinion. There are the skeptics who believe there is a bubble there, and most probably there is at some point, like with every other security. There are the people who believe this is a very good instrument for raising cheap capital. There are the opportunistic type of investors who see in a SPAC an instrument where they can make several multiples of their investment. And then there are all the other stakeholders involved in the setup of a SPAC, and also organizations that stand to benefit in some capacity from their existence and from participating in some capacity within them. Our objective here is not to politicize it or to promote it or anything like that. We just want to make sure that some of the fundamentals of a SPAC are being understood by interested parties. We'd like to bring forward elements around the capital structure of a SPAC, which is quite important for the majority of the investment community. Parts around the legal side and the legal structuring of a SPAC and how is that compliant with exchange and regulatory authorities rules, if there are any latest trends towards that as well. And of course, we want to inform people on the necessity, as it happens, of working on their management structures, on the human resource part of a SPAC. We think there are three core ingredients in any SPAC. Of course, it's the narrative, the sector and the segment that a SPAC is addressing. The sponsor is equally important. Successful SPACs tend to have very reputable sponsors. And of course, the management team. And the current and most probably the ongoing mantra of a good SPAC is that, it would have a team comprised of people who are known and well respected and received by the investment community for delivering value to investors. But SPAC, like everything else, is evolving. There are voices that raise some concerns on the conventional modus operandi of a SPAC, whereas effectively a sponsor seconds internal staff to the SPAC and to the management team. And we're seeing a trend, whereas increasingly independent professionals are being appointed to run a structure like that. So we're going to be having one of each. And I've left the insurance part as a last because not many people realize the importance of it. Like any corporate structure, especially a public one like a SPAC, would probably need, well, definitely the management would need, the individuals would need and request it, D&O type of insurance. And I think what people don't realize is that a lot of the investors, either at SPAC IPO or most probably at PIPE, as in on a different fundraising that a SPAC is doing, investors will be looking at how the insurance handled the SPAC and its management, what premium they have applied, what risk assessment they have performed, because this is a quite comprehensive due diligence on the structure itself. And therefore it's helping investors extract some information and therefore make an informed decision about it. So I wouldn't like to take any more of your time, just to say that feel free to put provocative and difficult questions on the chat box. Hopefully we'll have time to address all of them, but all the presentations are going to become available online, and the speakers are going to be making themselves available to answer any questions over email or phone hereafter. So I'll leave the rest to the speakers. And we're going to be starting with Robert from Taylor Wessing.
Thank you very much, Chris. I'm going to now try and share my screen, which I hope you can see. So let's start off with just quickly talking about us. So I'm Robert Fenner. I'm a partner at Taylor Wessing. We are an international law firm. We have offices all over the world, about 1,000 lawyers in total. Strong presence in all through Europe, the UK, Europe, into Asia, and we can basically give advice across the UK and into the US for SPAC purposes, in conjunction with Wilson Sonsini, with whom we have a partnership for US related work. And that's me. So I'm an M&A lawyer, particularly focused on the technology sector. So what's a SPAC? Let's start off with that. A SPAC is a special purpose acquisition vehicle, also known as a blank check company. It describes a company which basically has nothing in it. So it's a shell entity with no commercial operations at all, created by a financial sponsor. And the sole purpose of creating these companies is to raise capital on a stock exchange and via an IPO process. The actual process of creating a SPAC with nothing in it is not that complex. It's what it then does subsequently in terms of acquiring a target company, which makes it more complicated. And that acquisition of a target company has to occur within a specified time frame, and generally that time frame is 2 years. If you don't get the capital deployed within that 2-year period, then the SPAC has to return the money to its investors. Investors in the SPAC usually get units, which consist of a mixture of stock and warrants to subscribe for further stock at a later stage. And those warrants are generally priced at a higher price than the original subscription price for the stock. But by investing in a SPAC, what you're really buying into is the ability of the management team of the SPAC to find a target and make something of it. Because otherwise, all you're doing is actually going into, as I said, an empty cash shell, which has nothing else in it. In terms of the trading price, on an IPO, SPACs are typically priced at a nominal $10 per unit. That's typically what we've seen in the US. And unlike a traditional operating company, the SPAC price is not based on the valuation of any business underneath it, because there isn't one at that point. The units or common stock or warrants can begin trading subsequently, and then their prices will fluctuate, and you can split out the stock and the warrants to have them separately traded. But the fluctuations in price often don't bear that much relationship to the ultimate economic success of the SPAC, because often people are buying and selling the stock on the back of what they perceive to be the strength of the sponsors behind it and the management team who are out there looking for an acquisition. Promoters get a pretty substantial reward for setting up a SPAC. They will often get equity in the SPAC at a much cheaper price than the investors, so it's often around a nominal level, not a very high level at all, and they can get it up to around 20% of the SPAC for a small investment. Now, because that's pretty rich, there is competition amongst SPACs, and some of them have reduced down that promote from 20% to a 10% level, or even to a lower level, to show that they're more aligned with the interests of investors. But we have seen plenty with that 20% level in it. SPACs then, as I say, have a period in which to find a target, and in the interim, the IPO proceeds from the SPACs are held in a trust account. And so the money just sits there in an account, and it remains there until a transaction is consummated or until the money is returned to the investors in the event that the SPAC doesn't find a target within that 2-year period. So what are the advantages of a SPAC? Well, one is certainty of closing, because what happens is that when the SPAC wishes to go and do a deal with a target company, then that target company will simply enter into a business combination agreement, or in the UK, what we'd call a share purchase agreement, which combines the target company with the SPAC. So from the point of view of the target company, it gets certainty of closing in terms of being able to become listed. So that the target company, which has a choice, it can either go the IPO route and go and try and get itself listed directly onto the relevant market. In this case, we're mainly talking about US markets, or it can go the SPAC route. And the SPAC route means that it becomes acquired by or merges with the SPAC. And so what I'm saying here is that instead of having to go through a roadshow, which you have to do if you're doing an IPO, in this case, you're negotiating with the owners of the SPAC, the promoters of the SPAC, to do a deal with them. And that deal is closed by them signing a business combination agreement, rather than having the management of the target company go on a roadshow to persuade investors to invest in it. Because you get certainty of closing, you also get certainty of price. And again, the pricing will be as set out in that business combination agreement. So the target company isn't going on a roadshow and having to persuade investors to invest in it. It gets the pricing done through negotiation with the SPAC. If it were going on a roadshow, you'd have the roadshow, and at the end of the roadshow, the IPO sponsor would price the issue of the company seeking to do the IPO. Well, you avoid all that by going the SPAC route. You simply agree, as I say, a price with the SPAC itself. Another advantage for a target company that is doing a SPAC deal is that there are lots of SPACs out there, and they can select a SPAC sponsor that they think is a strategically good fit. So if the target company is a software business, for example, and it's looking for a sponsor, it will look around for a sponsor that has particular expertise in its area, in the area of software in which it specializes, and it could find that this sponsor adds value to the target company and its board simply by virtue of its specialization and its connections within that sector. And this also provides an alignment of interest between the SPAC and the management team of the target. So these are some of the reasons why people are opting to look at SPACs as a means of going public. So they'll find a SPAC and then they will combine with it as a means of going public. Now that SPAC deal is referred to as de-SPACing. So if you speak to lawyers in the US, and when they talk about de-SPACing, what they actually mean is combining a SPAC with a target company. It ceases then to be a SPAC because it's not then a special purpose acquisition vehicle, and it becomes a listed entity, which is a combination of the SPAC and the operating company. So it's no longer a SPAC then, that's why it's called de-SPACing. Challenges of a SPAC. So if you are looking to combine with a SPAC, then as a target company, one of the big issues you've got, particularly if you're not a US company, is meeting the accounts requirements. The accounts of the target company have to meet the US Public Company Accounting Oversight Board requirements. And these actually set out specific accounting standards which have to be met, auditing standards, sorry, which have to be met for a company to be admitted by the SEC to trading. And most European companies do not meet these requirements, and therefore you have to end up with a re-audit, and it can be a re-audit of up to 3 years worth of accounts, and it can take a few months to do. And so this tends to be the biggest obstacle to any European company looking to go and combine with a SPAC. Is that your accounts often have to be re-audited. Second challenge of a European company going and doing a SPAC deal is the question of whether it's ready to be listed on a US market. You need appropriate corporate governance in place, which you'd have to have if you're doing an IPO anyway, but you need to be able to report financial results on a quarterly basis. In the London Stock Exchange, for example, you need to report on a half-yearly basis, so this is more demanding. You also need to be able to meet applicable auditing standards, which I've already alluded to, and have appropriate internal controls in place. So this is where Sarbanes-Oxley comes in, and the quite extensive requirements that those impose upon companies listed in the US. And then going forward, you have to satisfy NASDAQ or New York Stock Exchange continuing obligations that apply to listed companies. So there are some advantages and disadvantages in going through a SPAC process for the company which is seeking to be listed. And we have seen a real boom in SPACs, as you all know about. So over 550 SPACs have been launched since the beginning of 2020, raising over $180 billion. The first quarter of this year alone saw the launch of more US SPACs than the whole of 2020 in terms of both the number of transactions and the amount raised. So there has been a tremendous boom. The numbers are actually tailing off now. There are not quite as many SPACs being launched recently. And if you look at the numbers over the last few weeks, they've trailed off quite considerably. The reason of that is that there's now so much money being raised and so many SPACs around that there is competition for targets. There aren't enough companies easily and accessible, which they know they can go and buy. And so a lot of SPACs are going around trying to find suitable targets at the moment. And because they've got a limited time within which to do it, that puts quite a lot of pressure on them in terms of who they speak to. They don't want to waste their time speaking to somebody who they think is a company which they don't think is going to be worth their while. And they particularly don't want to get into a long-term due diligence process, which could take a couple of months with a company which they don't think is going to be qualifying. And so for a European company which may be looking to combine with a SPAC, beware of that. And it's particularly relevant in the context of the re-auditing of accounts, which I've mentioned on my previous slide, where the time taken to get your accounts into order may actually put off some of the SPACs that would otherwise come and talk to you because they themselves have a limited time frame. So if you're a good target, there are lots of SPACs for you to talk to, but they don't give you a lot of time to get your affairs in order, and you need to be aware that you will be under a considerable time pressure when you're dealing with them. But it's a route to listing in the US, which hasn't been, which in the right case will be a very good option. One other thing I should mention is that in terms of the European markets, there have been very few SPACs in Europe. In London, SPACs are not currently possible because if you set up a shell company in London and you then want to go and acquire a business through it, the SPAC itself will be suspended, and so its shares will not be listed whilst it is going through the process of negotiating the transaction with the target company. And that's seen as a considerable downside because the investors in the shell company in London wouldn't then be able to trade their shares during that period. There is a consultation going on by the stock exchange at the moment who are proposing to change the rules to allow SPACs to come into play in London, and we expect that to be put in place later on this year, probably around autumn time. Other stock exchanges around the world are also looking at bringing in SPAC capability. Singapore's looking at it, Hong Kong's looking at it, but at the moment the US is out there in front because it can be done in the US, and in many of these other jurisdictions it's simply not possible. There have been one or two in the Netherlands, but it hasn't got anywhere near the momentum that the US has achieved. So that's a quick background to the structure of a SPAC. I can't recall now who we're handing on to, but
I think it's back to Chris.
Hello, can you hear me now?
Yep, all good.
Yeah, sure. Thank you very much. So we started receiving some questions, but all of them are going to be asked towards the end. We will continue. I mean, Robert already mentioned the importance of management within a SPAC and the whole process of structuring it through to attracting investment and then de-SPACing and the role that the management has in this process. So it's quite suitable that we pass on to Paul, who represents 7 Life Sciences, a specialty recruiter that has started offering specialized services towards ambitious SPAC stakeholders. So Paul, it's all yours.
Thank you very much, Chris. Hello there to everyone, and thank you for joining us today. I'm going to share my screen if we can do that. No. There we go. Hopefully everyone can see my screen.
Looks good. Thanks, Paul.
Wonderful, thank you. For everyone that doesn't know me, I'm Paul Harvey from 7 Life Sciences. I'm the Executive Client Services Director here. I head up the SPAC support team. And I'm keen to start with just a brief insight as to 7. 7 was established in 2016, a workforce in excess of 20 professionals here. Offices based in Suffolk, Essex, Miami, and the Gold Coast of Australia. Our key sectors are the biotech and pharmaceutical areas. However, there are plans, and we're slowly expanding outside that, to support SPACs in other industries as well. Something we do here as a recruiter, we use enhanced tracking software for people tracking and finding individuals that can be quite challenging to find, which aids in finding sort of key sort of management people as well, C-suite people specific. 7 offer a global coverage, as you can see, North America, USA, Canada, Western Europe, and the Nordics, Japan, Australia. Now, some of our clients, biotech and pharma companies of all sizes at all stages, from startups through to established pharma. Academics pursuing spin-offs. Venture capital and private equity funds seeking add-on capital for their portfolio companies, and also high net worth individuals and family offices as well. To give you a little bit of an idea, a couple of the clients that we're currently working with include GSK AI, who we're supporting with positions in Germany, the US, Philadelphia, and also London as well. They're developing an office in London, and also Thermo Fisher as well. Now, 7 Life Sciences and SPACs. Something obviously that I picked up that Robert mentioned is that you're sort of buying into the management team of a SPAC. One of the key ingredients of a successful SPAC is obviously the management team. The conventional modus operandi of a SPAC, the sponsor secons their team. So we at 7 I think that the future of SPACs lie within an independent management team. Let's move on. There we go. It is recognised that sort of having an independent management team is more favourable as well with book runners and also insurance alike, and we can obviously offer those resources as well. Seven work with a range of partner service providers that enables us to offer sort of bespoke support, guiding any organisations involved with SPACs. from insurance, underwriters, financial, and also legal as well. Now, the SPAC lifespan, there's three phases in the SPAC lifespan. There we go. First is the IPO phase, which is anticipated eight plus weeks in terms of timescale. The second phase is target search and negotiation up to 19 months. And finally, an approval stroke closing phase, which is 3 to 5+ months in terms of timescale. Now, 7, our role is to ensure prospective or current SPACs meet the market requirements. It's to ensure a flawless IPO or a successful PIPE. Now, SPAC capital structure. I'll say a few words on the SPAC capital structure. There we go. Okay, 7 tends to primarily be involved with the sponsors and the underwriting bank and Spac Structure advisors. We maintain a direct line of communication and being 24/7 available to cover any potential shortcomings, stroke changes in the Spac Structure or management team. There we go. Now moving on to the ESG components. We've implemented, 7 are one of the first recruitment companies to fully implement an ESG criteria into its business. It's been something that 7's been very, very passionate about, and it runs through the very heart of the leadership team here. It's also embedded into all of the new employees. As 7's growing at a significant rate, it's been sort of rolled out throughout all of the new starters here. We acknowledge that ESG is an increasing concern for investors, which is why it's been such a big focus for 7. Now, addressing institutional investors' requirements on ESG, our primary focus has been towards the governance side. We inform investors on ESG perimeters of each venture. We can effectively have, we have to have a buy-in to the proposed SPAC, and we need to feel comfortable with each and every one of its stakeholders as well. Now, anyone sort of falling short of our criteria, we would work with them, but it's very much in a support capacity to develop and help them to get to where we would like them to be. Now, the implications of our approach, the key points, the key points I want to sort of pick up on here. So how does this translate for you? The key points: getting the right team for the right job, the key skills. It's the difference between a good or a bad SPAC. More investable proposition to investors through conversations with various sort of venture capital, private equity companies that I've had more recently. It's been recognised that the management team is an independent management team is key, and that's something that they are looking to sort of roll out in future SPACs that they're involved with, which was really good and positive to hear. We think we're at a SPAC 2 world with enhanced SEC and oversight and compliance. Ultimately, we think our approach protects the investors' interests as well. Now, our journey and modus operandi, delivering a premium service and advanced service offerings for our clients. We have a dedicated SPAC advisory team here. Our market monitoring team enables us to network with individuals who potentially weren't considering a move, and also giving our clients the very best the market has to offer at the time, and combining that with the candidate people tracking software really gives 7 Life Sciences an edge. The best part of what the best part of all that we offer is we operate on a success-only basis as well, which isn't sort of too well known of. And I think as soon as I sort of mention that, it's quite refreshing, really, because there's a lot of recruiters out there that only work on a retained basis. Now, having the stakeholder relationships that we have, it enables Seven to really understand what individuals are needed when building out the management teams. Ongoing relationships with the place professionals also allows us to make sure of a smooth and successful transition, and also it gives us a really good understanding from the top, enabling us to successfully recruit throughout the business at all levels, from lab through to C-suite. Now, our objectives here at Seven, growth. This year has been a significant year of growth here within Seven, and I anticipate it will continue to do so. We need to continue to work, we intend to continue to work with the investment community as well as a main objective of ours. I would like to thank everyone for taking the time out of your day to listen to me and being patient. I look forward to any questions that you may have.
Thank you very much, Paul. Thanks for your insight in the human resource part of a SPAC. There are a few questions stemming out of that.
Okay.
So I believe we can proceed to our next one. Sorry. Yes, and we have Sylvia from iBanker Securities. And she's going to be telling us all about the capital structures and what an underwriter tends to do, how do they get to work with all the stakeholders involved, and what is the current trend with specific focus on the biotech industry for SPACs. So Sylvia, all yours.
Okay, so thank you very much, Chris, for the introduction, and thank you everyone for your attention. I'll just give you a very brief intro on iBankers. If you don't know us, we're a private boutique investment bank founded in 1996. We're headquartered in New York, but we have offices. I'm afraid my slide slipped down, but it is here. We have offices in Europe between Milan and Lugano, and then we have other offices spread across the US. I particularly look after the European, both investors, potential sponsors, and potential targets. So if you're in any of these categories, I'll be very happy for you to relate to me. We have acquired a big name in the SPAC world. We were the third bank to enter the SPAC market on Wall Street in 2004, and we're the only bank that consistently brings US SPACs to Europe. I'd like to latch on to what Robert was explaining about the Spac structure. So here you can see my screen, right? Yeah. Okay.
Yes, all good. All good.
Yes, we can.
So we basically have 3 players in the SPAC life cycle: the sponsor, the investor, and the target. The role of the sponsor is to pull together a management team, find investment banks, which will then investigate the market to find investors. And the sponsor will be setting up an escrow account with a primary bank to minimize the risk of bankruptcy, although the money of the investors is in an escrow account invested in 90-day T-bills. So an escrow account by law can only be broken for the reasons it was set up for, which is the liquidation of the SPAC, which happens whether the SPAC now finds a target or whether it does not. So the money is as safe as it can be. The only risk for the investor is the US default. That's the risk profile, basically. The sponsor then lists, or the investment banks for the sponsor list the SPAC on the NASDAQ and New York Stock Exchange, and then they begin the target quest. The investor provides the cash and has the right to trade the SPAC on secondary market from day one. The concept of the SPAC, I think that you're probably all familiar with it, is very much that of a private equity investment, but it's much more investor friendly than a private equity investment would be, because you have no lockup, you're traded from day one, and you can decide to redeem and exit for any reason without any need to justify it, whether it is because you don't like the business combination or whether it is because you simply need to regain your capital. Alternatively, which is what every sponsor would hope for, you participate in the business combination. The target has an option to do an IPO in a much more friendly, less time-consuming and less cost-consuming way than a traditional IPO would be. So we have an interest alignment with a SPAC. For the sponsor, it's the possibility of seizing an acquisition opportunity immediately, very much again referring to the private equity space, where basically you go to a target with cash in the bank, and therefore it's quicker and easier to conclude an operation. Repeat SPAC sponsors also benefit from the pipeline, because although it is not allowed to already have a memorandum of understanding, a letter of interest in place with the potential target, it is also accepted that if you have done some market scouting, you maybe have some targets in mind which weren't available for the first round when you did the first SPAC, but may become available in a second round. For the investor, the advantage is that he has an equity investment with at least 100% plus T-bill, which today is negligible, yield redemption and potential upside, either between the announcement and the actual business combination or following the business combination, plus free optionality. We will see later how we've said that the risk profile is that of a risk-free, therefore of the default of the US, but actually the return is higher than the comparable risk-free. Participation in the IPO compared to the secondary market guarantees for the investor fixed price, free derivatives and no commissions. For the target, as we've said, it's an easier and faster route and a cheaper route to market listing. And as Robert was saying, it gives maximum capital structure flexibility, because you know at what price you're going to be listed with no surprises from the market. There's a lot of information on this slide. I won't go into every detail. It's basically just to show you how during the lifespan of a SPAC, which goes from the IPO to the shareholder meeting that determines the business combination, when then we have the reverse merger of the target into the SPAC, you can identify two phases. One, which is the light blue arrow that you see on the slide, when basically the investor is invested in T-bills, therefore he's invested in a liquid cash alternative, although he has an additional benefit, which is the yield from the trading of the derivatives. At the moment of the announcement and from there on to the shareholder meeting, you have what for the investor is a golden period, and for the sponsor maybe a bit of a black period, because that is when the investors will decide from a fundamental basis whether they actually like the business combination or not. So it is true that they're still invested in T-bills, but actually it's a proxy trading on the underlying, because at this point in time, you as an investor know what the fundamentals are, what the multiples are, what the peers are, what the comparables are. So you're still invested in a liquid cash alternative with the same risk profile. You still have the right to redeem your capital if the performance does not satisfy you, but you can actually take part in the upside. And you're in an IPO basically, because you've only just known what it is actually going to invest in, but you also, it's already listed, so you also see what the rest of the market thinks about it. So in this phase, we have a very interesting situation, which I don't know on any other equity on the market, which is an asymmetrical risk-return profile. It is an equity, the SPAC is an equity, has an alphabetic ticker, but we've seen that it has zero risk, or whatever we can call zero risk in the financial market for the investor. All the risk is on the sponsor who's put up the capital in the beginning, and who, if he does not conclude a business combination, or if the business combination does not fulfill the requirements of the investors, will lose all the capital that he's put in the game. So why have SPACs grown so much, as Robert was saying? Here we've made a simulation of our currently listed iBankers SPACs, which have not yet announced an acquisition. So we are in this phase of the lighter blue arrow. There is no news flow. So in theory, they should be performing like zero coupon bonds, because basically in a perfectly balanced market, the SPAC should be discounting the time to maturity plus yield on escrow. There's always some imbalances, there's always some arbitraging, but that's the concept. In reality, we see that the average yearly estimated return, which you see in the table on the left at the bottom right, is actually 4.1%, which is, if you compare it in the graph on the right-hand side, much higher than the comparable free risk investment. What they are actually invested in, the SPACs, which is the 90-day T-bill, now has 0.2% return. But European same maturity comparables actually have a negative return. And the SPACs instead will give you a 4.1% return. This we've calculated from the actual market return on the warrant as of April 21st, the return on any right, any additional yield in escrow that the sponsor may put to entice investors to select his SPAC, and the average yearly estimated combined return, including the T-bill, which is minimal at the moment. Now, this slide shows you the golden graph, so the time between the announcement and the actual business combination, when as an investor, you can still exit the SPAC by redeeming. And you can see that the return, this is the upside potential I was talking of a few slides earlier, is actually very, very interesting. Now, our best SPAC, because again, these are historically our SPACs from 2004 onward, has granted a 583% return, which is a very nice return on a free risk with a maximum 24-month maturity. Now, the other numbers are dwarfed by this, but if you look at the average, you still have a 52% average return. So if you build up a SPAC portfolio, that's the kind of return you can be looking forward to. And none of these SPACs will actually lose you money as an investor, because the minimum return has been 5.1%. So as a sponsor, you can see what your problem is. First of all, here on the left-hand side, you can see the number of SPACs that have been IPO'd from the start of 2021 and all the years going back to the very first SPAC that was listed in 2003. So this year, in 3.5 months, we've had 308 SPACs for total proceeds of 99 billion. So this table on the right, the graph on the right shows you the proportion of SPACs. The gray column shows you the dollar amount, and the blue column shows you the amount in terms of numbers compared to traditional US IPOs. So out of all the IPOs for every year on the NASDAQ and New York Stock Exchange, for 2020, over 50% in terms of dollars of capital collected and over 60% have been SPACs. And for the first 3.5 months of 2021, we've had 65% in terms of capital collected and nearly 80% in terms of numbers of SPAC IPOs issued out of total market IPOs. So as a sponsor, you can see what your problem is. First of all, you can see that it's very attractive for investors to actually just play the vehicle and get out, whether that is at the business combination or on secondary market between the announcement and the business combination. And secondly, that as a sponsor, you're competing with a lot of other SPACs. And as a broker, I can tell you it's really difficult to get 308 SPACs into investor portfolios in just over 3 months. So what happens here on the left-hand side, you see the number of SPAC IPOs. It's just the table we saw before, but in a graph format. And you can see how steep the curve is, how much it has increased. So the intensified competition means that sponsors need to make their SPAC more attractive. We can come back to this slide, but I just wanted to show you this. How do you differentiate in a competitive market? Now, basically, you have 3 levers, which then go into a lot of sub-levers. First of all, the name of the sponsor. Obviously, if you have a name or a role that is of universal resonance, we've done SPACs with one of the founders of Facebook, with Soros, with the ex-COO of Coca-Cola, with the ex-CEO of New York Stock Exchange. Now, these names resonate, not just because they're smart, because really every SPAC sponsor is smart. Because when you go and do a SPAC IPO, all you can show the market is that you're smart. You have no fundamentals, no story to tell. So if you're not smart, no one's going to look at you and give you money. So it's not really that these people are particularly smart. It's just that they probably have a very good network, or at least as an investor, you would expect that. They have very good management teams available, and they have infinite resources, and they have a lot of face to risk. Then you look at sponsors that have an impressive background. So as a SPAC sponsor, what are you giving investors? You're giving them some value add. You are very good, for example, in life sciences, just to make an example. You have a 30-year career in the sector. You've done M&A in the sector, and that's what you're bringing to the market. And maybe your sector is a sector where it's important for investors to be guided. I think, for example, of biotech, which perhaps not many investors, except for specific investors, but the generalist investors are probably not that well knowledgeable in. And so your value add as a sponsor is that you can actually guide them in a sector, picking for them the best picks and giving them a private to public discount on the best picks of the market. Very much like, again, a private equity investor would do. Another way to differentiate is what sector you're in. Now, maybe you're a market darling. For example, you're in the same sector as Tesla or Nikola right now. Maybe you're in a sector which has scarcity of SPAC competitors. So you're differentiating yourselves because of that, geographically or sector-wise. Robert was saying that Europe obviously is a bit more difficult for 2 reasons. One is the size of the companies, because an average SPAC in the US now collects around 300 million. And we've seen SPACs that are way over a billion or a couple of billions. So for European targets to have that kind of size is rather unusual. And also the question of the accounting, as Robert was saying. Another advantage of the sector can be the scarcity of listed companies. If you're in a sector which is attractive because investors don't have many opportunities of investing in listed companies, that's also very appealing. The third ratio is the structure. Now, the structure, you can see that you can do a lot of things with the structure to make it more attractive for investors. For example, instead of giving half a warrant, which is the base case, or a quarter warrant, which is what rockstar sponsors are allowed to do, you will give the market a full warrant. You will maybe add a right. You will pull down maturity from 24 months to maybe 12 months with extensions that earn a yield for the investor. Or right from the start, you can put additional yield in the escrow account. Now, all of these ideas will be an additional cost for the sponsor. And some of them will also be an additional dilution at the business combination. So what the market is doing right now is thinking ways of structuring IPOs smartly to reduce sponsor cost and to enhance investor stickiness. I'll give you an example. We've seen that some SPACs have rights. Now, a right is a very nice thing because compared to a warrant, you have a strike of $0. So basically, it's a bonus share with a 10-to-1 ratio. Every 10 units that you've bought at the IPO, at the business combination, you get 1 bonus share for free. So it's very attractive at the moment of the business, at the moment of the IPO, but think of the moment of the business combination and think of a business combination that's not very appealing to investors. Now, you probably know that you can substitute the investors of the IPO with new investors, and there's certain thresholds. I won't go into it because if not, I'll be talking on and on forever. So what happens is if the business combination is not very appreciated by the market, but the sponsor still manages to close it with the appropriate amount of capital and appropriate amount of investors, on day one after the reverse merger, all those investors that did not really want to stay in the company and that have redeemed will find themselves with additional bonus shares. So the probability is that they will throw them on the market because to them cost is zero. So even if they pull the stock down to 9, to 8, to 7.5, it's all additional value. So for the sponsor, this is a little bit of a poison pill because maybe you've done a really good business combination, but maybe you've done it in a sector that's different from what you suggested to the market in the beginning. And maybe it's not your fault. Many things can happen. But you find yourself with a really good business combination and the stock suddenly in 1, 2, 3 trading days is down at 8.5. And it's very difficult to go back up to 10. So you need to think very carefully of which kind of structure will not cost you too much as a stock sponsor, will not be too attractive at the IPO so that all the investors will be flippers and redeem at the business combination, and will enhance investor stickiness. My last slide is just a very brief focus on this specific sector. So I find the sector as biotech, healthcare, beauty and wellness. And in this definition, currently less than 8% of listed SPACs calculated on the capital collected belong to the sector. So if you're a sponsor looking to IPO, or if you're a target in this sector, you do have a competitive advantage because you do have a differentiation compared to the other sectors. I've had a quick look at the structure of these SPACs in this sector that are currently listed, and only a minority offer a full warrant and or a right, which means on a first glance, but then obviously, you know, if you're thinking of actually doing a SPAC IPO, you'd have to do a much more in-depth analysis, that it probably wouldn't cost you that much to be a distinctive SPAC in your specific sector. I'm good. I'm done.
Okay, thank you. Thank you, Sylvia. We can proceed. I mean, it was really interesting. We're slightly off time, but I think it was important to get all the information from every single speaker. So we have now David Garrigus, who is working with Hub, which is an insurance broker, US-based, and one of the top insurance brokers specializing on SPACs. So David will be telling us on his experience in insuring SPACs, and especially on the D&O side of you know, the directors of the management of a SPAC and the implications of their work on these SPACs. So David, please inform us.
Thank you very much, and great to have this time with everybody. I will move through this very quickly, given timing, but would welcome having separate conversations with anyone who would like to go into any additional level of detail. Very quickly on Hub. Hub is a top 5 global broker based on revenue, soon to be number 4. We are within our organization, I run a specialty team focused on management and professional liability. And within that, we have a team focused on complex transactions, including these days, more than 80% of our time focused on SPACs and de-SPAC transactions. The perspective that we share, the perspective that we have on the market comes both from experience in brokerage, but also I led this group within an underwriting organization. And you'll hear that a lot of our approach is around risk differentiation in a very difficult D&O market for SPAC sponsors. Included as well on the team, we have Whitney Ross, who is an attorney who helps us with crafting policy wording. She's spent quite a bit of time putting together a compilation of litigation against SPAC sponsors, which we can certainly share. And then also in advocating on behalf of our clients in claim situations. We also have team members, including Andrew and Lena, who engage throughout the process, including in risk and insurance diligence as our SPAC sponsor clients are evaluating de-SPAC candidates. as we go on. These are just a couple of example representative transactions. At any given time, our team is working with between 15 and 20 SPAC sponsors. This is a sampling of some direct IPOs and SPACs that we've represented in the past 12 months. We talked earlier and heard from others on the dramatic growth in the SPAC market. This really is the basis of a lot of the hardening of the D&O, or directors and officers liability insurance marketplace for SPACs. In particular, what has come out of the increase in the sheer number of SPACs is a focus from both regulators and the plaintiffs bar, and that has been the source of a lot of D&O underwriter concern. We believe that understanding what's driving underwriter concern allows us to formulate a message to the D&O insurance marketplace that allows underwriters to get more comfortable and ultimately offer a much more favorable outcome on pricing and terms than they would be able to otherwise. If we look back at when the D&O insurance market for SPACs started getting particularly hard, it was comments at the end of September of last year made by the then SEC chairman, Jay Clayton, where he called into question the sufficiency of sponsor due diligence, driven in part by what he saw was a misalignment of incentives, in particular, a strong incentive for a sponsor to complete a transaction as opposed to not complete a transaction. That's been followed with the new SEC chairman, Gary Gensler, in his saying that he will include SPACs in his enforcement agenda. And then, of course, more recently, his proposed change in the accounting treatment of SPAC warrants, which has, we think, some pretty significant implications. Of course, it's really caused a delay for a lot of new SPAC IPOs while sponsors figure out how they will be treating SPAC warrants from an accounting perspective. It may also change some folks who have completed a business combination already to consider a restatement of financials. As important, we believe, is how this is messaged to the D&O marketplace. This has been an area of particular concern since this was announced last week. And so we've worked with leading D&O underwriters to work through some of the questions that you see here. And for the sake of time, I'm not going to go through these in detail, but again, this presentation will be available after, and would welcome the opportunity to spend time with anyone who would like to discuss SPAC risk in more detail. As we look at risk overall, one of the things we were asked to do for today was to really discuss what D&O underwriters perceive to be higher risk characteristics of SPACs and lower risk characteristics of SPACs. And we've called out some here. These are common held beliefs by a number of SPAC D&O underwriters. And again, we believe that key to success in this market is really understanding the underwriter's view and tailoring a message to address particular issues. For example, a sponsor who has experience making private equity or venture capital investments may have diligence as really a core capability, which can be a distinguishing characteristic in a positive way. But on the flip side of that, we may need to more specifically address perceived conflict of interest issues. And so we think it's really important to distinguish the team, the strategy, and also to be proactive with regard to any underwriter or any issues that underwriters may perceive as higher risk to ultimately drive the right outcome. In terms of SPAC D&O insurance, the structure of a D&O insurance program for a SPAC is a little different than what most are familiar with. Unlike the traditional annually renewing programs, SPAC D&O programs are traditionally written for a 2-year period to cover the search term. There is some opportunity here to lower cost by breaking that into smaller pieces. So for example, we might elect an 18-month term with a 6-month extension, knowing that most SPAC sponsors can complete a business combination within the first 18 months. We also pre-negotiate, very importantly, what we call a runoff or a tail policy that attaches to the initial D&O policy. That provides 6 years following the de-SPAC transaction in which new claims can be brought alleging wrongful acts or misstatements or misleading statements or failures in diligence prior to the de-SPAC transaction. Because it's very difficult to show shareholder losses prior to funds getting released from trust, we typically don't see litigation until after the completion of the de-SPAC, though we may see plaintiffs' firms announce upon the announcement of a pending transaction that they are investigating that proposed transaction. That runoff is really critical because that's typically when the claim is made, and that's something that we pre-negotiate at the front end of the SPAC offering. In terms of structure, We can spend more time in another setting going into structural considerations. There are a number of different ways that we can structure a SPAC D&O program that can help mitigate some of the increases in cost that we're seeing in the market overall. In terms of limit trends, we're actually seeing sponsors buy comparably less limit now than they have in the past, not at all driven by the risk environment, really driven by budgetary constraints in a market with significant increases in cost relative to historic levels. We provide some examples here of where we currently see sponsors purchasing. This we update monthly, could be done more so based on changes we're seeing in the market. Again, while there is significant increases in price that we're seeing, there's a lot that can be done, which individually may have a small effect, but cumulatively can have a very large effect on the pricing in the program overall. In addition to looking at things like reallocating the amount dedicated to full form D&O versus a type of D&O we called Side A, dedicated to protecting the personal assets of insured persons. We can also look at, for example, allocating more of the cost up to the runoff period, which is payable when funds are released from trust as part of the de-SPAC transaction, versus the upfront period, which we can then lower, typically where there's more sensitivity around cost because you're dealing with finite risk capital until the monies are released. We could also consider alternative capital providers. That's something we can go into more detail on separately, but there are non-traditional solutions that may be available to SPAC sponsors that can be more efficient than traditional insurance market solutions. As important as getting the price right, we believe, is getting making sure that the coverage responds appropriately. The only thing worse than spending this much money on a D&O program is then to not have it work in the event of a claim. And it seems like every day there are new and inventive ways that insurance carriers are excluding portions of the coverage. Understanding what those landmines are as they evolve and how to navigate those to make sure that coverage responds appropriately is a key focus of our team. And so we spend a lot of time helping you understand the differences in coverage and the implication for those differences. We provide in follow-up a case study of how this can be, how this can play out, which again will be available for review after the presentation today. The last thing I will mention in today's conversation is that we really engage throughout the timeline. It's not just a single D&O insurance placement on the front, but rather it's making sure that we are working with you through the diligence process and through placing the runoff and tail as well as the go forward D&O coverage for the operating business post de-SPAC. A lot of that is education, helping our clients understand how risk as a publicly traded business, operating business, differs from the risk as a privately held business, and how do you value that risk properly. So with that, I know we're short on time. But hopefully this was a helpful overview.
Yes, I think it was. Thank you very much, David. Truly appreciate it. I hope some of the details of the speakers can be made available afterwards to attendees so that people can raise their questions separately and privately if they so wish. I think, well, I can see also that a lot of the questions that have been raised on the chat box have been answered kindly by everybody participating. Nevertheless, I have picked up a few questions that I'd like to address specifically to some of the speakers, just in case we can get an answer. These have not been answered. So the question is whether a UK target company combining with a US domiciled SPAC can retain FPI status. Does it need to be re-domiciled during the de-SPAC to be ex-US, or do the FPI tests still apply? Could David perhaps have a say on that?
That may be better directed to one of the attorneys on the phone. I'm certainly happy to share
just
some
in case you have a,
but yeah.
Robert, what about you? Do you have any feedback on it?
There's something we're going to have to take up, to be honest, with a US attorney rather than just with an English attorney. So I think that, yeah, we can talk about it, but it better be offline because I'll need to introduce somebody from the US to talk about that.
Fair enough. Okay. And a couple more that I have. We got a question from Glenn Travis on whether there is a list somewhere of SPACs looking for a particular type of assets. And I think I understand what Glenn is asking. Basically, a SPAC essentially is seeking a combination with a target company they're obviously targeting something specific, like within a sector, a specific domain that they have identified as of interest. Now, every single SPAC, at least on their S1 form, is stating that they haven't got any target in mind. They haven't done any work beforehand. I believe that for a large part of them, they probably, have an idea, at least prior to forming the SPAC. But nevertheless, there seems to be an increasing number of SPACs that are approaching their end of life, and they haven't got in sight anything to acquire. So there's a real risk of basically finishing the SPAC unsuccessfully. So I guess the question is, if there is somewhere a space or a web place or a dedicated service so that interested companies can identify SPACs that may be of interest to them, i.e. the other way around, instead of a SPAC looking for targets, a potential target looking for a SPAC, so they can hopefully do business together. Would Silvia, do you have any response to that?
So, well, we can certainly provide a list of SPACs by sector, by size, by maturity, how long they still have to go. That's very easy and quick to do. I don't know if I should share my email on the general chat, and if someone has the question, I mean, I can't do it right now, but I can pull it together and send it to you within a day or two. So I don't know if I should put my email address on the chat, and who needs it can refer to me.
I think if you're comfortable with that, by all means, please input your email so that people can address you.
If you need that, and certainly we can help understanding, for a target, which the best fit in terms of SPAC would be. The detail that we also have is what kind of percentage the SPAC would like to acquire of a target, because that SPACs more often than not look for targets that are 4 or 5 times the size of the capital they collected. But sometimes we have SPACs that want to acquire 100%. So in case of someone wanting to sell out everything, we could find a match there. So we can do that, absolutely.
Very good. Thank you. Thank you, Silvia. There is an add-on question on top of that on whether there is a list of SPACs that have actually failed. And I guess, this is the next step of a response for you, Silvia, or anybody else who might have a say, who might know something about it. By all means, please circulate your findings and your results.
Yeah, I mean, there's been a few answers also from David, I think, and from myself on the chat. Yes. So David, I think it was pointed out correctly that you need to understand what you mean by failure. Now, the SPAC itself cannot fail, because the SPAC is defined by the time between the IPO and the shareholder meeting, where the investor has the option to redeem out. During that time, especially towards the end, the SPAC will never go below 10 plus escrow. I mean, it can sometimes for some market inefficiency, but the arbitrages will immediately step in. Yep. But let's say that you find yourself in a surreal situation where the SPAC goes below 10 before the business combination is agreed on. Well, the investor can simply redeem, so he has no way to lose. In this sense, a SPAC cannot fail. If you're talking about the post-SPAC, which is not a SPAC anymore, so let's call it the business combination phase, the equity, just the traditional equity that you have from the de-SPACing, we've done a comparison between SPACs and traditional IPOs listed in the same time frame and we've looked at them over the same period of time with the same kind of market cap. And we've seen that the performance is very, very similar. Now, in the time frame that we analyzed, actually the SPAC performance was a bit better. I cannot say that this will be true of every market period because it depends on how the market is, if the market is hyper or not, and which sectors are favored versus which aren't. But we've done it over a number of periods, and always there's very, very much similarity between how the business combinations perform and how non-SPAC IPOs of similar size perform. And the performance is about 50-50. Some go well, some go bad, which is what you would expect. So there's not really a big difference between investing in a SPAC or in a traditional equity IPO.
That's great, thanks. I think the question was probably from potential sponsors, because it's within their interest to understand. For them, failure, I guess, is failing to acquire, to secure a target,
Right.
and therefore resulting in complete loss of their investment. But
Sure.
I don't think this can be answered immediately right now, but I think...
It can.
Oh, can we? Okay, let's go
Yeah,
for
because
it.
we've got statistics on that. So
Okay,
again,
great. If you have statistics, that'll be great.
yeah, it depends from the market period. Right now, when I say right now, it's up to the end of 2020. The rate of failure was below 10%. So less than 10 SPACs out of 100 who IPO'd did not successfully conclude the business combination. If we look, for example, at other market periods, 2008, let's say, then the rate was much higher. It was around 30%. But that's not really due to the SPAC structure. It's due to the real market being, you remember, in 2008, a market where there weren't many sound companies to buy at a reasonable price. So both SPAC, IPOs, and private equity funds had a hard time right then.
Great. Well, thank you very much, everybody from the speakers. Thank you very much, everyone from the attendees. Thank you for giving us your time, and I hope you have found it informative. I think that every single speaker's email address has been circulated here. By all means, feel free to communicate directly to them. And I'm sure Tony and the One Nucleus organization is also an excellent conduit to take on specific comments, specific requests, and channel them appropriately. Thank you very much.
Thanks, Chris. And absolutely, if you've got other queries, and we will circulate a note after this with a link to the recording, so you can go back and if it's like me, understand the scribbles of writing notes you made and then don't know what the words say. So you can look at the recording and remind yourself. But I'd just like to thank Chris for some great moderating. The speakers, I thought they were really good presentations with plenty of food for thought to take away and have to rethink about, and probably will have questions. So it's brilliant that you've shared your contact details, and it'll make it very helpful. So from me and the One Nucleus team, I've been Tony Jones of One Nucleus. I still am. It's been a pleasure to work with our partners on this, including Seven we did in association with. And thank you all for your time. And I'm sure we'll be back to this topic many times, and we'll look forward to digging into it a bit more. Thanks very much.
Thank you. Thank you very much, Tony. Thanks, everyone.
Thank you.
And
Thank
bye.
you.
Bye-bye.
Take care.